Well, it's a very good welcome from me, and it's a very good welcome from him. Hello, everybody. Welcome to my live stream, mortgage live stream, Monday morning's live stream, 12 o'clock, or it's thereabouts, 12 o'clock anyway. Hope you enjoyed a good weekend. Didn't we have a good old bash for Queen, eh? Platinum, 70 years. Started watching the Crown on telly. We've gone back to 1952. It's quite interesting to see how it all pans out. But lovely weekend. Weather was miserable. Blah. But that's just typical of this country in early June, isn't it? So anyway, let's get talking about all things mortgages and all things financial services. So anyway, let's go on air, shall we, and do this all properly, as they say. Got a couple of topics for you today. Going to take a look at continuing on our topic on the 15-minute discovery call in a minute. So I'm going to take you through qualifying people, which a lot of mortgage advisors don't do and quite get. So we need to make sure you're comfortable with that terminology. But before then, let's talk about changes. Things change all the time, don't they? Each week goes by, some new information comes in, so we can reassess our thoughts and opinions. Lots going on in the economy at the moment. A lot of mortgage advisors, mortgage brokers getting a little bit worried about the state of the economy, the housing market, interest rates and stuff like that. Many new people to the mortgage market, particularly in the last 3, 4, 5 years, haven't really experienced a recession or interest rate rises. Not really quite sure what to do about it, because the market, as far as they're concerned, has been booming. There's been plenty of business for everybody to have. Now things will slightly tighten up, so you do need to plan ahead. So let's talk about the forthcoming downturn and how it might affect mortgage advisors, really. Now, all the talk, as you know, is on stagflation. Now, I talked about stagflation a couple of weeks back. It's a combination word, isn't it, stagflation, between stagnation, in other words, an economy that's hardly growing at all, probably falling in GDP, not doing particularly well, and inflation, high inflation. So you've got a stagnant economy, which we've pretty much got at the moment, and you've got high inflation, which we've pretty much got. So you get what's called stagflation. And you've got the energy price cap was announced, wasn't it, for October? Was it £2,800 or something per annum for the average user? That's a massive increase. So everyone's getting really quite worried. Everyone's feeling the squeeze, aren't they? All consumers are feeling the squeeze, and they're all starting to think about their direct debits and their costs, etc. And they're starting to slow down their spending, or their anticipated spending. So you've got things like deferrable purchases being deferred. We went into John Lewis on Saturday looking for a telly for the bedroom. And the sales guy, who was all features, he said, right, I want to show you the best one you want for your bedroom. He showed me this telly for 1,500 quid. And Shelley said to me, we don't need to spend 1,500 quid on the TV for the bedroom. And this bloke just didn't get it, because everybody is deferring their spending. Now, that will possibly produce a consumer-led recession. We're a consumer society. We're a consumer-led economy, and therefore, if they stop spending, the recession kicks in. Now, that's all changed, I think, because of what Rishi Sunak did last week. Possibly timed it for Boris's no confidence vote. I don't know. It's all politics at the end of the day. I'm not going to go into that. But the point was that Rishi basically handed out a load of dough, a load of cash to households direct. He's given money to all households to cope with the increased energy costs. He's also particularly given it to the poorer households, which is the right thing to do. People on benefits, retired people on pensions. He's given them a lot of money, a lot of wonga, a lot of cash. There's no like sort of credits or anything, it's money. He's basically put money into the economy by the end of the year. And they estimate it's about 15 billion he's putting into the economy. Now, he's getting it through a windfall tax, and that's fine, but he's also getting it from further borrowing as well. He's come up with a dough. And what that means is that a lot of people will not feel the pinch as they first did. A lot of people will have money paid into their bank accounts. They can pay the gas bill. They can also pay for the extra food costs as well. So some of the poorer members of society on welfare benefits will actually get quite a bit of money, which is the right thing to do, because their food costs have gone up more than the average person's food costs. Which means, therefore, that consumers don't feel the pinch so much. And the logic is they won't feel the squeeze, therefore they won't cause a downturn. And that's good. Now, the Bank of England, of course, old Bailey and his lot over there, this funny chap, isn't he? they're quite relieved about this because they're a bit late in pushing up interest rates. Because quite rightly, they thought the problem wasn't an economy booming, because it wasn't. It wasn't monetary policy expanding that caused the inflation. It was supply bottlenecks like oil and energy and food and all those things caused the problems of wars and stuff. So interest rates going up doesn't actually help, because they are increasing interest rates now. And what they're worried about is if they increase interest rates, they'll cause a recession. And they don't want to do that because that's not good for everybody. So they've been very wary. They've only been going up by 0.25% and stuff. But now, of course, they think, well, actually, no, a recession probably isn't on the cards because people have got money in their pockets. So we could actually increase interest rates a little bit more and get rid of that inflationary impact. So it's helping them out too. And the other thing is, consumers are still sitting on, they reckon, about £200 billion of savings money glucked from the pandemic, still sitting in the bank account. And the banks, of course, are lending this cheaply on mortgage, aren't they? That's where you get cheap deals from high street lenders. So there is a bit of money about. And I think what Rishi did last week is pure fiscal economics. That's what he's done. He is the fiscal chancellor, the first conservative fiscal chancellor ever, I think, because he's spending money. He's not. They're not doing austerity, which is monetarism, isn't it? Shrink the economy by contracting the money supply. That's austerity, or expanding it by putting money into it. So they're expanding it effectively. I think it's a good thing. I really do, and it may well avoid the downturn, which is good for everybody, good for mortgage advisors, good for everybody. So I think that's good news all around. So everything changes. Remember, you have to look at what changes, what effect it's had, and look at the mirror, look at the horizon to see what's going on. So that's a bit of an update for you. Hope that's been useful. Great. Hope you're well. Hope you're good. We're all good here. We're really busy this month now, updating all our materials. We've got a lot of exam syllabuses changing. Not a lot, actually. People get really hyped up about the new exam. Oh my God, it's all changing. Oh my God, I can't cope. But actually, there's a tiny bit of changes. These institutes kind of market it as though, you should buy now while stocks last, but it's nonsense. The changes are minimal, but we're going through all our videos and everything. Now, for those of you on boot camp who are you've got your system and you sign in, don't you? You get all the videos and audios. We're updating those in the next few weeks automatically, so you don't need to do anything. Those of you that have books and things, we're revising the new books by the end of June, and we're doing new audios as well, or just having a look at them to make sure they're all okay. Many have been recorded evergreen anyway. So we're busy next couple of weeks updating our materials. So I'm looking forward to doing that. And that's on the protection exam, that's on the equity release exam, and that's on the CMAP exam as well, which is the basic mortgage one. Remember, we provide online learning to help you, or on-demand learning to help you to pass exams that you need as a mortgage advisor. So that's all coming up a little bit later on for you. Let's get into my next topic, which is continuing the theme of the 15-minute discovery call. So I'm going to go to some slides now, because if you're watching, you can see some slides. If you're on podcast, well, I'll talk it through anyway, so you can hear it clearly. So let's just change the view for you. We'll go to slides, and I know, why don't I pop in and say hello, because I'd like to do that as well. So I'm coming on in now and popping on into the slides, and look at the right camera, which is that one over there. We're looking at the 15-minute mortgage discovery call. We had a brief glance at this a couple of weeks ago when we looked at the first few parts. And this is what the 15-minute discovery call looks like. This is the content of the 15-minute discovery call, remember? It's the first 15 minutes when you've agreed to talk to the customer or client, whatever you want to call them at that point. They are a customer, actually, because they ain't paid you nothing. So they're a customer at that point. And the whole point behind the 15-minute discovery call is it allows you to lay out how you work, lay out what your value proposition is. It allows you to present your fee, your status, etc., get client agreement to pay for all that, and then continue by pressing the time clock where you start charging. That's the whole point behind the 15-minute discovery call. And we're looking at this bit here. We've looked at this earlier. It's qualification, qualifying the customer. So let's just have a look at this in a bit more detail, shall we, for you? Qualifying the customer. So what is the concept of qualifying the customer? Well, as you can see, to qualify or not to qualify, that is the question. And you may want to do this now. It depends on how you market. If you get a lot of customers coming to talk to you, you do need to qualify them quite robustly. His little picture there of thumbs up, a bit like the old Roman emperor, isn't it? Yes, I'll have him, or no, I won't have her as my client. I was reading about some mortgage advisors that use TikTok for their marketing. Brilliant way of doing it. And they put a load of videos out. They get tons of inquiries. People coming to say, look, can you help me? I've got this problem, this problem. But because they get so many inquiries, they have to qualify rigidly to make sure the customer is right for them and they're right for the customer. Otherwise, you just end up spending a whole load of time with customers who are just wasting your time. Broadly speaking, tire kickers, we call them in the sector. A bit horrible, isn't it? But people go and buy a new car, they just kick the tires to see if it's okay. They're not really looking to buy a car, they're just kicking the tires because they can. Or somebody that's just blatantly shopping around. People shop around for mortgages, of course they do, and they'll shop around for mortgage brokers. And if you get into that game, you're on a losing streak. You really are. You start getting into the shopping around gizmo. It's just a complete and utter waste of time, isn't it? But let's get into how we do this then. Well, in certain sectors, the equity release sector, there's the Equity Release Council membership thingy. In the equity release market, you have to qualify customers out of equity release by law. It's an MCOB 8 rule that you have to show the client other ways in which they can obtain the finance, better ways that they can obtain the money rather than equity release. And that's really important, isn't it? Because that's what you have to do. Now, as a mortgage advisor, though, you need to take some steps to decide whether you want to keep that person as a customer or not. And it's about having an attitude in your head. I call it famine or feast. Now, you either wake up in the morning with an attitude of famine. In other words, oh my God, it's another week. Oh, it's going to be so hard this week. I need to get some more clients. I'm under pressure. I didn't make any business last week. I've got to do something. The first person I see, I'm going to sign them up for a mortgage or else I'm in trouble. That's an attitude of famine, which means that everything you look at becomes famine. It's like locust infestations. Or you can wake up in the morning and have an attitude of feast. Great. It's Monday morning, brand new week. I'm going to go and talk to loads of people. I'm going to do some great work and I'm going to talk and chat and we're going to get some great mortgages going for my customers. I'll see some customers, I'll do some business because I follow the process and it works every time. It's different attitudes that you have. If you've got an attitude of feast, then you will qualify people. If you've got an attitude of famine, then you will talk to anybody that's got a pulse and you'll try and get their business. And that's wrong. That's very wrong indeed. Now, it does depend on where you've come from. Now, let's go back a few years. Let's go back to the 2008 financial crash, which of course was 14 years ago now, a long time ago. Now, I was in the marketplace at that point. It was horrible, absolutely horrible. Here's a picture of people queuing up outside the Northern Rock when they were nationalised. There was a run on the banks. There was a complete and utter crash. Everything just went wrong. Banks stopped lending. Securitization stopped immediately, of course. There was no wholesale money. Specialist lenders just went to the wall, brokers went to the wall, there was no business. So in that situation, you would be desperate for any customer you could. But things have changed. We've now got 2022 mortgage boom, effectively, fueled by the house market, stamp duty, embargo a few months back. Things are looking quite rosy, so you can pick and choose your customers. But at the end of the day, you do need to do it. And what I want to do now is just share with you how you can qualify people. Now, I've got a little acronym called MANT, M-A-N-T, which helps you to understand how to qualify people. So let me just take you through MANT and see what you think about this. The first category, if you like, is what we call motivation. First of all, you need to find out in the 15-minute discovery call why they want to talk to you. What's motivating them to want to do all this? What's their big goal here? What's their overall objective? Do they want to buy that old semi-commercial block, do it up into buy-to-lets and make some money? Do they want to move for their family because the family's getting older? What is their underlying motivation behind moving or remortgaging or whatever it is they want to do? If you can find this underlying kind of exciting motivation, then you will know that they are going to go ahead with whatever it is they want to do. They're not just having a think about it. So that's the first one. Then it comes ability. Now, ability is different to motivation. This is, do they have the ability to do this? Have they got the ability, for example, to sell and buy a house? Have they got a house in the market? Are they looking to buy? Do they have the affordability basis. Can they afford it for the mortgage? You'll no doubt be assessing that at some point. Do they have the ability to pay your fee? Whether they have the motivation or not is another issue, but do they have the ability to pay your fee? Do they pay fees before? So ability is a really key one as well. Then it comes down to, I think, the most important, the need. What is their need here? Different to motivation. We call fact-finding the needs analysis, and I get all that. You're going to find out what the customer's needs are for the mortgage, and you're going to look at ways of writing the suitability letter to demonstrate your compliance. And I get all that. You've got to do that. But point is, though, do they need you? And that's really important. You're a mortgage broker, mortgage advisor, whatever your title is, and you cost money. You cost a fee, at very least a proc fee. They could go direct. Why don't they? Why haven't they? Have they searched around the internet? Have they come across a stop sign where they can't go any further and they need a broker? Maybe they want to access a lender that's not available to them. Maybe they have a specific requirement. Maybe they have a stain on their credit report or something. So therefore they need you, the mortgage broker. Otherwise, guys, they will get what they can from you for free and they'll just go shop around and get it direct, because people do nowadays. There ain't much loyalty going on. So that's the thing. Do they have a need for you? If they're looking for sort of bridging finance, for example, if it's development finance, why do they want bridging? They can just get a straightforward remortgage. It's damn not cheaper. Bridging's too expensive. So why do they need that? Why is it they have to have money from an auction? They've just been to an auction, buy property. They need money desperately, So what is the need behind the whole purchase? We're not doing a fact find here. You'll do that later. Of course you will. This is about qualifying the customer. Are they right for you and your business and your character and your personality and all those good things? Obviously, that comes into it too. Are they a fit? Is there chemistry between? Do you like them? Do they like you? I know you're not supposed to do business with people you like, but that'll make it much more enjoyable, doesn't it? I mean, I train some people that I just don't like them at all, but I love training people that I actually quite get on with. It's much more fun at the end of the day. The last one is T, timescale. In other words, are they going to do this now in the next couple of months, or are they just going to do it and they'll finish off in 2023, or they're just having a look to sort of test the water, that kind of thing? If they are, you'll want to treat them accordingly, get them on your database, start keeping in touch with them, put them on your incubator. Of course you would, but you're not going to be dealing with them there and then. If they're a fit, maybe that's great. If they're not a fit, then now it's time to say goodbye. Pictures, they ain't fitting me. I need to say goodbye. Now, the concept here is don't be so desperate for business. There's a great book you might want to read by Robert Cialdini's fantastic book called Influence, Psychology, Persuasion. And it's the science of influencing. It's being reprinted many times. Brilliant book. You definitely want to read it. And he talks about the science of influencing people. He's got 6 shortcuts which you use to influence people. And scientists use this to influence people and persuade people to do things. And the important one here is what we call scarcity. You want to come across as scarce. You want to come across as not right for everybody. Because there's only one of you, well, it might be a firm, of course. There's only one of you, and you're not right for everybody. And you need to have the guts sometimes to say goodbye to people. But you need to do it in a certain way. And one of the best phrases to use is this one here. I'm not right for everyone, and I may not be right for you. And just see what happens. They might kick back and say, yes, you are. I want to do business. I want to pay your fee, etc., etc. But you do need to test it. This is a close in a way. And I use this when somebody is becoming a bit of a nuisance. A potential corporate customer or personal customer that's asking far too many questions, and I've qualified them. They're not right. Haven't got the time scale or something. I say, look, I understand where you're coming from, but in business, I'm not right for everybody. Always blame me. Never blame the client. I'm not right for everybody. I'm not the right mortgage broker for everybody, and I may not be right for you. And just see what they say. See if they come back and they say, no, Paul, you are right. Durr. I love you to bits. I want you to do my mortgage, etc. But it's time to say goodbye to some people and be ruthless about it as well. If you know they're not right for you, and trust the gut. By the way, after a few years in this business, you will know when somebody's right for you or when they're not. But if they are right for you, little tick box there, ta-da, then what you want to do now, as far as the 15-minute discovery call is you need to move on to how you work. So great. Let's now talk about how I work. Let's talk about how I earn a living. And then we can talk about getting the ball rolling. How does that sound? And if they're interested, they'll say, yeah, okay, we'll have a listen to that and see how that comes across. And that's qualifying. There's nothing wrong with it. If you're professional, you really ought to be doing it. Hope that's been useful. All righty, let's head back over here, shall we? Because that's the little bit of an excerpt I wanted to give you on our 15-minute discovery call. And what we'll do next week for you is we'll take a look at how you sell your fee. How do you get your fee across to the customer, and how do you sell it? Remember, you've qualified them now. You want to do business with them. They're right for you. So you really want to be presenting the way you earn a living. Not, let me tell you how I charge my fee. No, it's how you earn a living. Everybody needs to earn a living. How you look at it. And most people respect that because they have to earn a living. So we're going to talk about how we do that next time we meet. Other than that, we'll wrap that up. So let's end our live stream and wish you all the best for this week coming up. Hope the weather gets better. It's pretty appalling. It's been chucking down with rain last couple of days. The weekend for the Queen's Jubilee wasn't the best of weather, was it? Typical early June in this country. You can see why everybody wanted to go abroad last week during half term. Although you do fear for those people who are still stuck abroad, who can't get home because it's A-levels and GCSEs this month, isn't it, for kids? Well, not kids, they're adults. So let's hope they all get home pretty quickly, even though EasyJet, British Airways and TUI have been cancelling flights left, right and centre. You do feel for people who are just trying to get away, get a bit of sunshine, because we just don't get it in this country, do we? Anyway, enough of that. Enjoy the rest of your week. I'm Paul Archer. Let's keep in touch and see you next week. Bye.